What's the line in the sand between the difference on public debt markets and private debt markets? Like, what would be a couple of example on either side?
Yeah, great question. So public debt literally means public company, essentially, right?
Okay.
So you have Apple, you have Google, you have Exxon, you have all these public companies that generally raise debt capital, especially in the last couple of years since the rates were so low. It made sense, right? I could essentially not dilute myself and still raise capital to be able to finance my growth. And so in that instance, the public company is the borrower. The investment bank would be the underwriter. And then the insurance companies and the pension funds would be the investors. And so that worked great, right? Everyone knew that ratings agencies would step in to say, is this investment grade or is this high yield? You had legally required audited financials. So everyone had to report the same way on the data side. You knew who played in that space. And so nice, well-run $52 trillion market. On the private debt side, it's interesting because so many people have probably interacted with private debt before and never actually realized it. So if you've ever taken out a student loan from like SoFi before they became public, that was private debt back in the day, right? Because SoFi is not a bank. And so they need to raise debt capital from somewhere to be able to finance their loan portfolio. If you took out a buy now, pay later loan per se from a firm prior to them going public, that was also private credit, right? So everything's small business lending, consumer loans, factoring invoices, litigation finance, equipment leasing, the list goes on. That is all technically considered private debt. And it's an extremely interesting asset class that just doesn't get enough credit, I think, today. No pun intended.